What if I told you there's a company that delivered a fully operational power plant in 55 days, when new power projects are sitting in grid queues for up to 7 years? That's not a typo. 7 years just to get approved to connect to the grid. And the biggest names in AI are throwing billions at this company because of it. Here's what's happening. Every hyperscaler on the planet, Microsoft, Oracle, Google, Amazon, is in a full-blown arms race to build AI infrastructure. But they keep running into the same wall. The power grid is completely maxed out. Thousands of projects are lined up waiting for interconnection approval, and the queue keeps growing. So when one company figured out how to deliver gigawatts of on-site power, bypassing the grid entirely in a matter of weeks, Oracle didn't just sign a contract, they came back and asked for more.
So let's talk about what this company actually makes. They manufacture something called a solid oxide fuel cell, or SOFC. Let me break it down simply. Traditional power plants burn fuel to spin turbines to make electricity. It's loud, it's wasteful, it creates pollution. This company does something fundamentally different. Their energy servers convert fuel, natural gas, biogas, or pure hydrogen, directly into electricity through a chemical process. No combustion, no spinning parts, no noise. Here's what makes it genuinely special for data centers. Number one, it's always on. Unlike solar panels that stop working at night or wind turbines that stop when the air is still, these fuel cells provide continuous, reliable power. That's exactly what a data center needs. Number two, it deploys fast. We're talking 55 to 90 days from order to operational. Compare that to the 5 to 7 year wait for a grid connection, and you can see why hyperscalers are absolutely throwing money at this company. Number three, it's fuel flexible. Running on natural gas today, plug in hydrogen tomorrow. That pathway to clean energy is already built in. This isn't a startup. They have 1.4 gigawatts installed across more than 1,000 locations in 9 countries. The technology works. But a great technology alone doesn't make a great stock. What you need is the right technology at the right moment. We are living through the biggest infrastructure build-out of the 21st century. Every major tech company, Microsoft, Amazon, Google, Meta, is spending hundreds of billions of dollars building AI data centers. By some estimates, total AI infrastructure investment will hit $1 trillion by 2030. Now, these data centers are absolutely massive power consumers. A single large-scale AI facility can need 500 megawatts or more. That's enough electricity to power an entire city. And the power grid simply cannot keep up. Interconnection queues, that's the waiting list to connect to the grid, are 5 to 7 years long in most of the US. So what does a company like Oracle do? They need power today. They find this company, they place an order, and 55 days later, 55 days, a fully operational power system is running at their data center. Oracle was so impressed, they just expanded their agreement. They're now contracted for up to 2.8 gigawatts of capacity from this one company. That is not a small deal. That is one of the largest power supply agreements in the history of tech. All right, let's talk numbers. For a long time, years in fact, this company was burning cash. Classic growth stage energy company. But something changed. In the first quarter of 2026, the company reported $751 million in revenue. That is a 130% increase from the same quarter last year. It gets better. They posted $71 million in net income. A year ago, they lost $24 million. That's a swing of nearly $100 million to the positive in 1 year. Adjusted earnings per share came in at 44 cents. Wall Street was expecting 3 cents. They delivered 44 cents. And they generate cash now. $74 million in operating cash flow in a single quarter. The cash burn era is over. The company also raised their full-year guidance. They now expect $3.4 to $3.8 billion in revenue for 2026, approximately 80% growth for the full year. Gross margins expanding to 34%, operating income tripling. Look at this gross margin chart. It has been expanding every single year since 2021. This is a company that has figured out how to scale profitably. This company has been growing revenue every single year. Look at this chart. From 2021 to 2025, revenues grew from roughly $1 billion to $2 billion. Steady, respectable growth. Then suddenly, 2026. The company now expects $3.6 billion at the midpoint of guidance, an 80% jump in a single year. What's driving that? Two things: the AI data center boom and a massive surge in backlog.
Their product backlog stands at over $6 billion. That's future orders already signed. Their service backlog, the recurring revenue from maintaining existing systems, is over $14 billion. That's nearly $20 billion of locked-in future revenue sitting in the pipeline.
Let me tell you about the deal that made Wall Street sit up and take notice in April 2026. Oracle struck a major partnership with this fuel cell company, and then they just expanded it. The total agreement is for up to 2.8 gigawatts of fuel cell capacity, enough power for over 2 million homes for one company's AI infrastructure. Oracle has already committed to 1.2 gigawatts, with deployment expected within the next year alone. Oracle needed power for what they're calling Project Jupiter, a massive AI and cloud computing facility build-out. They couldn't wait for the grid. They turned to this company. The original delivery timeline, 90 days, which is already fast. They delivered it in 55 days. Oracle came back and asked for more. They went from one facility to a multi-year, multi-gigawatt expansion. That is the ultimate customer testimonial. So who else is in this space? Look at the table. Fuel Cell Energy, their closest pure-play competitor, is struggling with losses. Plug Power focuses on hydrogen for forklifts and mobility applications. Different market entirely. Ballard Power, transportation fuel cells, buses and trucks, not data centers. The biggest competitor is the power grid itself, and the grid is losing. In the most power-hungry markets in the country, Northern Virginia, the Texas data center corridor, utilities literally cannot meet demand fast enough. And then there's the patent portfolio, over 1,000 patents globally. This is not technology that someone can just copy in a garage. The IP moat here took 2 decades to build. And after Q1 2026 results, the reactions from Wall Street were dramatic. Look at these price target upgrades, all on April 29th, the day after earnings. RBC Capital went from $143 to $335. Morgan Stanley raised from $184 to $210. BTIG went from $165 to $295. Mizuho went from $110 to $285. Of the 20 analysts who cover this stock, half have it rated buy or strong buy. 45% are a hold, only 5% recommend selling. Now, the average analyst price target is $234, and the stock was trading around $261 when I pulled this data. That means at current prices, the stock is actually trading above the average analyst target. The bulls are pointing to targets as high as $335. The bears have targets as low as $55. This is not a consensus boring hold. This is a stock where conviction matters. All right, let's talk about the risks. Number 1, valuation. This stock is trading at more than 20 times annual revenue. That is an extremely high multiple, even for a fast-growing company. At this price, the market is pricing in near perfect execution for years to come. Number 2, execution risk. The company is trying to double its manufacturing capacity in a single year. That's a massive operational challenge. Number 3, customer concentration. Right now, the story is almost entirely about US AI data centers. If big tech CapEx spending slows, this company would feel it hard. Number 4, natural gas. Most of their systems still run on natural gas. If gas prices spike, the economic case for their systems weakens. And finally, insider selling. After the stock went up 17 times in a year, insiders are cashing out. The chief legal officer sold 35,000 shares. A board director sold 25,000.
Now, the company we've been talking about is Bloom Energy, ticker symbol BE, trading on the New York Stock Exchange. So, what's my take on the stock itself? The bull case is compelling. The AI power crisis is structural. It's not going away. Bloom is the only company proven to deliver gigawatt-scale on-site power at the speed hyperscalers need. They've crossed into profitability. They have $20 billion in locked-in future revenue. The bear case is also real. At over 20 times revenue, this stock is priced for perfection. The average analyst target is below where the stock sits today. Doubling manufacturing capacity in 1 year is a massive execution risk, and insiders have been selling after a 1,460% run in 12 months. My personal view, this is a genuinely world-class company solving a genuinely critical problem. But at current prices, most of the obvious upside is already reflected. The technically smarter play is to watch for a pullback and consider building a position gradually if the thesis holds. This is not financial advice. Do your own research. Whether it's a buy at these prices is a question only you can answer based on your own risk tolerance and conviction level. But if you've never heard of Bloom Energy before today, now you have. Hit the like button if this was valuable, subscribe for more deep dives, and drop in the comments, are you bullish or bearish on BE? See you in the next video, and thanks for watching.